Pretty recently on the channel, I did a video going over Smith & Wesson stock, Smith & Wesson being the American gun manufacturer. I opened up a position in that stock, and then it proceeded to tank about 25% in a matter of days. And other gun companies seem to have felt some of the pressure as well, including the company we're going to analyze here today, and that is Sturm Ruger. For those of you who like to follow some of the bigger value investors out there, you might know that Phil Town actually owns Sturm Ruger in his portfolio. So if that's a vote of confidence, maybe it's worth a further look, and we'll go ahead and take a look at what's going on with Sturm Ruger. This will be a fundamental analysis on the company, looking at the metrics, seeing if it might be worth a buy. At the end of the video, I'll also do a basic intrinsic value analysis using a discounted cash flow model. But before I go any further, I need to emphasize that this is not financial advice. You need to come to your own conclusions and do your own research when it comes to investing. I can't make a decision for you. All I can say is that how you invest depends entirely on your own risk tolerance and your own assumptions. Anyways, let's take a look at Sturm Ruger Company, that is ticker symbol RGR, and see what we're working with. As we can see on their stock chart, they are pretty much flat on the year, up only about 5% after taking a pretty hard dive in the last couple of days, down from the low 70s into the mid 60s. So a pretty significant drop. Not quite as significant as Smith & Wesson, which saw a nearly 25% drop or something around there. It's fluctuating a little bit, but very significant drop after somewhat disappointing earnings over on Smith & Wesson's side. They missed their earnings by a bit, but really their numbers seem to indicate that that dip might be a bit of an overreaction, though totally depends on your outlook for the gun market. But we'll get into that in just a second. Sturm Ruger's market cap is at about $1.15 billion. And one thing that might be attractive, depending on your style of investing with this particular company, is it has a pretty hefty dividend. And I'll get into how that's structured. I've done some preliminary research. This is kind of my first look at the company as well. I haven't done super deep analysis into the company, but just looking at the top level metrics, there's certainly something here, and I think it's worth a further look. But anyways, Sturm Ruger and Company, together with its subsidiaries, design, manufactures, and sells firearms under the Ruger name and trademark in the US. It operates in two segments, firearms and castings. The company provides single-shot autoloading bolt-action and sporting rifles, rimfire and centerfire autoloading pistols, single-action and double-action revolvers, and firearm accessories and replacement parts. The company also manufactures and sells steel investment casings and metal injection molding parts. Sturm Ruger and Company was founded in 1949 and is based in Southport, Connecticut. So that's your basic overview. Let's get into the financials and see what's going on. Hey guys, real quick, go ahead and check out the affiliate links in the description below, especially those links for Webull and Robinhood. If you go ahead and sign up using those links, you get some free stocks. I get some free stocks as well, so it's a win-win. Go ahead and do that. It's free money.
It's free real estate.
The first thing I always like to do when I look at a company is taking a look at its balance sheet to see kind of what's going on between their assets and liabilities. Do they have a lot of debt on the balance sheet? Do they have a lot of cash or some other sort of asset play that you can take advantage of? So let's take a look at that. Starting with their cash, they have around $20 to $25 million in cash on the balance sheet. And then short-term investments, I'm not sure what that means exactly, since cash equivalent would typically include treasury bonds or something like that. I don't know what this means, short-term investments. But that's $165 million, so that's pretty significant. So total cash and short-term investments is around $190 million. So that's pretty significant compared to their market cap of around $1.15 billion. And if we move on down to liabilities, we can see how that compares. We see that they don't really have any leases to worry about, or at least not very much. They have no short-term borrowings, but it doesn't look like there's any long-term debt on the balance sheet, which is great. That means that they're largely debt-free. I mean, they have some accounts payable and accrued expenses, probably in relation to the actual merchandise that they're moving, but that's probably going to get paid down at some point, and it's more of an accounting sort of expense just to make sure that everything is accounted for, not so much a large debt load. At least that's how I would understand it. So really, compared to their cash, they're in a really good position. They have around $190 million between short-term investments and cash, and then really not much by way of debt, no long-term debt to worry about. And one other very important thing to take a look at on the balance sheet is how many shares outstanding they have. Are they issuing shares or buying them back? And it looks like over the past few years, they have been buying back shares, not at a particularly aggressive rate, but significant, though it looks like in the last 12 months, they maybe have issued a few shares compared to the previous couple of years where they're actually buying them back. When a company is buying back shares, that means that you, the shareholder, are actually getting a greater share of the overarching business because there are less shares out there. there. You have a greater share of that same business, the same amount of profits being created. They're just simply less slices of the overarching pie. On the flip side, share issuance will cause what's called dilution. And when you're diluted as a shareholder, that means that you have a lesser share of the overarching business and its profits because there are more shares out there. It's very much like inflation when we're talking about the US dollar. But not a whole lot going on here, which is not really a problem. I'd be more concerned if there was massive amounts of shares being issued because that would imply that you're going to be diluted. So even if the company is growing a ton, you're kind of having a lot of the effects of that growth negated by the growth in shares as well. But that's not the case here, so we can move on. Let's go ahead and take a look at cash flow. This is the lifeblood of the business. How much profit are they bringing in? How much free cash flow do they have to invest back into the business to pay out dividends? I did mention they have a pretty hefty dividend, so we'll get back to that. But let's take a look at their free cash flow, which you get by taking cash from operations minus capital expenditures, and we can see that their free cash flow has been mostly increasing. They did take a dip in 2019, which is interesting. And in 2020, where gun sales were at record highs, they did go up, but probably not as much as you might have expected. If we go ahead and stretch this out a little bit, let's go back 16 years, and the company has been steadily growing with some ups and downs, not exactly exponential growth, but significant nonetheless. And this is their free cash flow against. This is the money that can be used for practically anything. So it's really what you're aiming for as a business. You want as much of this as possible, generally speaking. And let's go ahead and compare this to top line revenues. If we go back to the income statement and then hit revenues, and this is over the last 16 years, we can see that it has been pretty steadily growing, though you could say it's probably plateaued. It has come down from its all-time highs in revenues. Actually, they hit an all-time high in 2013, and then we're pretty close to it in 2016. And even in 2020, they weren't able to hit those numbers. So that kind of concerns me given the amount of gun sales that there were. And when competitors like Smith & Wesson, for example, had massive spikes in revenue during that time, I wonder what was going on with Sturm Ruger. I'm not sure if it just appeals to different clientele, perhaps. I think they do a lot of competitive kind of shooting products, but I don't know what segment of the market that is. But anyways, this has me concerned that they probably won't see a ton of growth, even if the amount of gun owners in the US and in the world continue to grow at a pretty substantial pace. And I just switched revenues to a quarterly view, and if we look at the last few years on a quarterly basis, we can see that revenues have continued to increase quarter to quarter just over the last few years, so not compared to their all-time highs, but you did see a dip in the last quarter based on the earnings reported on October 2nd. So I don't know if that's a sign of more decreases to come in the future. I think investors are probably anticipating that given what they saw with Smith & Wesson, which reported a slight decrease in sales compared to the last year. So you might see the same thing happen with Sturm Ruger if they follow the same general trend. And if we look at free cash flow on a quarterly basis, we can see a pretty similar trend that it's mostly upwards with some swings, and it is starting to decline heading into the present day. They had some pretty massive capital expenditures in the end of 2020, so I'm not really sure what that's about, if maybe they started some new plants or something like that. I'm not really sure what happened there. But anyways, the general trend with revenue has been mostly followed by free cash flow as well, though it does seem that their free cash flow does vary quite a bit more than the general upward trend of revenue, since there are some pretty significant swings here. All told, their free cash flow for the last year is at about $110 million if we take the cash from operations of $180 million minus $60 million in capital expenditures. This is over the last 12 months. That would leave us with about $120 million in free cash flow from the past year. That means that they're trading for about 9.5 times free cash flow, and their price to earnings ratio, which takes earnings rather than free cash flow, is at about 7.5. Now, I did mention the dividend, and it seems that theirs is a bit unique in that it's not a fixed yield. Right now, the dividend yield is at around 5%, so that's pretty significant, but I want to see how they come to that number. And apparently, if we look at their recent earnings report, the actual dividend is approximately 40% of net income. So it'll depend on their earnings, which I guess is a good thing from the company's perspective, since it's not as though they have some fixed barrier that they have to meet. They have to pay out some fixed dividend. They have to pay out, say, $1 per share or something like that every year. Instead, they're just paying out the 40% of their net income, which is very significant. Don't get me wrong. It's not as though that's some easy thing to meet, but they have some flexibility, I guess, in that if they have a poor year, it's not as though the dividend is going to stay the same. It'll actually shrink with net income as well if that happens to fall. But still, it's a very significant dividend relative to their actual net income, 40% of it. And this is definitely going to hamper growth for the company since they're outlaying 40% of their net income. That can't be used to invest back into the business. That can't be used to create new plants, create new products, do all sorts of things that you'd want a business to do if it was going to be growing. They can't do that since they're paying it out to shareholders. Now, you might be able to invest that money at a great return, but ideally you'd want a company investing it if it is good at investing back into itself, at starting new ventures and all the things that are great about business growth. But that's not going to be as easy when 40% of net income is being given to shareholders just by nature of being shareholders. But maybe you're not looking for a company that's going to grow a ton. Instead, you just want some more stable dividend payer if you assume that the firearms industry is stable and you think Sturm Ruger is a stable cash flow company that's going to pay out a decent amount of its income every year to you, then Sturm Ruger might be a great fit. But this isn't to say that the company can't grow. I'll actually pull up the graph I used in the previous video for Smith & Wesson, and that's this one right here. This is the total amount of background checks reported by the government. We can see that they have dramatically ticked up over the past few years, really over the past couple of decades, where you see over the past 21 years, we've seen a massive increase in the amount of background checks, which suggests that there's greater interest for firearms, greater interest for people trying to buy new ones. This doesn't mean that this is the total amount of sales in general, since a background check is before you get to an actual sale. So again, no guarantees that this actually means that sales are going up at the same rate. But I would think that this is a tailwind for the firearms industry in general. And this last number in 2021 only goes up to October. So we haven't even gotten the most recent data. So this is a couple months short, and you might actually see this number tick up to closer to 2020 levels. And back to the dividend, you can see that over the past few years, the dividend has been increasing. So they've been paying out more and more profits to shareholders. And this could be something that you're really into. You really want to see the cash flow stream from your stocks without having to sell them off. The taxes are a lot different, and it might not make sense in your situation to want dividends because of higher taxes, but in some cases it can make more sense when it's something like qualified dividends. It depends on your tax status and your taxable income as well. So definitely talk with a tax professional if that's something you're worried about. But anyways, the dividend has been pretty substantial and has been increasing at least over the past few years. But do keep in mind that dividends are not magic. When a company issues dividends, they're going to be taking it from the value of their business. It's cash on their balance sheet. It's cash flow that they would have had to reinvest into themselves. So when a company issues a dividend, you're going to expect the business value to decrease at the size of the dividend. But the shareholder gets the cash in return. So it's not as though you're in a worse position, but the company is, at least in the short term. They're losing that cash. Maybe they attract more investors who just want that dividend, and maybe that pumps up the share price. But generally speaking, when a dividend is issued, you're going to expect the business value to decrease when that dividend is issued. So finally, let's get to an intrinsic value calculation of Sturm Ruger. This is using a discounted cash flow analysis, where you take all of the cash flows of the business over the next decade, in this case, discount them based on your discount rate, which is more like your required return, and then you can come up with an intrinsic value that way. And if you assume that the market is going to reach this intrinsic value at some point over the long term, assuming these assumptions are true for growth and all that stuff, then this tells you what price you might want to pay for the company if you're trying to get it at its intrinsic value. So anyways, let's start with the growth rate. This is the growth of free cash flow. I went ahead and said the cash flow would only grow at 2% per year over the next 10 years. That might actually be a little bit high given where they're starting from. We do have to keep in mind that a lot of the money is going out via dividends. It's not going back into the business. So it might be harder to grow this free cash flow number than otherwise, at least within the company. Maybe you can grow it yourself, but again, that's getting outside of the actual intrinsic value of the company. But let's see what happens if we use a starting cash flow number of 120 million. That is their last 12 months. You might assume that that's a bit high, so we'll do a more conservative analysis in just a second. I'm using a terminal value of 12 times free cash flow, which is maybe a little bit low. Typically, a mature company with stable cash flows is probably going to be around a 13 to 16 PE, at least when we're talking about historical average. For a higher quality company, it's probably going to be closer to that 15 to 16 range. In this case, because it's a gun company, there's some controversy there, and I do want to be a little bit more conservative when I'm looking at something like this because of all the regulatory risks unique to the gun industry, and plus the obvious controversy of selling firearms. I'm going to use a terminal value of 12 for their free cash flow. We'll add that on to the intrinsic value, and then I'm using a discount rate of 15%, which means that if I get it at this intrinsic value, and if everything here comes true, I could expect a 15% return on my money if I get it at the intrinsic value value. So we get all of our cash flows growing at 2% per year. We discount them based on the discount rate. We get a present value of future cash flows of about 1.09 billion. And that also takes into account the final business value, which is taken by our terminal multiple of 12, multiplying it by the year 10 cash flow of, right here, it's 150 million, multiply that by 12, and you get 1.76 billion as kind of the final value of the company at the end of year 10. But then we discount that by our discount rate multiplied over these many years, and then we get to that present value future cash flows. But then we add on the excess cash they have right now as well of 190 million. We add it on to get an intrinsic value of 1.28 billion, which is actually above the current market cap. The current market cap is 1.14 or 1.15. I'll go ahead and change that to 1.15 because that's more accurate. And we have a margin of safety of about 11%. But you might say, and I would probably say as well, that this $120 million in free cash flow might be a little bit too lofty given the current environment with guns. You might expect a decent decline over the coming quarters. We saw what happened with Smith & Wesson. Granted, it wasn't a massive decline, but let's be a little bit more conservative. Maybe say $90 million or something like that as a starting cash flow. And then assuming 2% growth or maybe even 1% growth, especially given the amount of money that they are not reinvesting back into themselves and instead are paying out in dividends, which is factored in here. You still have it in free cash flow, but it's not being reinvested into the business. It's just being given to shareholders. So we'll say 1% growth at a $90 million starting free cash flow. And then all of a sudden it doesn't look as great. You have an intrinsic value of 960 million, even though it's trading for over $1 billion now. Then you have a margin of danger, we'll call it, of 17%. So it really depends on your assumptions. And that's with anything with investing. If you lower your discount rate from this analysis to, 11%, then it is at fair value. And that's assuming that terminal value of 12. Maybe you bump this up to 14, then it looks better. So you can kind of massage this however you want. Maybe you do a negative growth rate because you don't believe that the tailwinds for firearms in the US are as strong. You think that maybe they're going to be in a worse position than they currently are in future years, but it doesn't mean that it's a bad investment if you can get it at a great price. So all I'm saying is that there are lots of assumptions you can make. Definitely do your own research and come to your own conclusion here, but it looks like it's pretty close to fair value based on these assumptions, so we'll see what happens. For me personally, I think Sturm Ruger is a bit on the expensive side, at least compared to something like Smith & Wesson, which I think is trading at a more significant discount, but that's for me personally. Maybe you value something like that dividend a lot more than I do right now, so you might want to go for a company like Sturm Ruger. It's definitely something I'll keep my eye on, but right now I already have a significant position in Smith & Wesson, and I'm not trying to create a diversified basket of gun companies because they all share a very similar sort of systemic risk, and I want to be careful not to be overexposed into one industry like that, especially if there's one company I already like in it, at least so far. So I wouldn't expect to be investing in Sturm Ruger anytime soon, but hey, I'll keep an eye on it and see what happens with the price. And they could always grow a bunch, and then all of a sudden it looks like a great value play. Anyways, that's all I've got for today. So if you like this video, please like it. That's how it helps the channel out a lot. And if there's a particular stock you want me to take a look at, definitely let me know in the comments below, and I'll do my best to get to it. Otherwise, be sure to subscribe since I put out new videos as they have to do with personal finance and investing every single week, and I wouldn't want you guys to miss out. And check out those affiliate links in the description below. But until next time, take care.